Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. August surprised to the upside with a record number of new all-time highs posted in the S&P 500 index, and both Nasdaq and the Dow reached new peaks as well. There were gains for equities outside of the U.S. as well, and according to regional data from S&P indices, only Latin America and Asia failed to post a positive return in the final month of summer. The S&P Latin America 40 index fell by a modest 0.11%, whilst the S&P Asia 50 index was 0.01% lower over the month. In terms of sector performance, consumer discretionary stocks and materials were the laggards in the developed markets, excluding the USA, down by 1.44% and 1.51% respectively. If we look at performance on a global basis, we find that it's the energy and materials sectors that finished August in negative territory. Though once again the losses were relatively modest at 0.82% and 0.74% respectively. So much for August. Then what about September? After all, the ninth month of the year has a reputation for producing poor stock market returns, with an average decline of 1% in the S&P 500 dating back to 1928, giving us a loss-to-win ratio for the month of 54 to 48% in favor of losses. Let's not forget that we saw a 10% correction in equity markets during the first 3 weeks of September last year, even as global economies emerged from stringent lockdowns. We can see just how quickly and relentlessly markets moved lower in this chart of the S&P 500 index during that period. Against that background, should investors be circling the wagons and moving into cash? Well, not so fast, because following the very weak August non-farm payrolls data, it's tempting to think that the Federal Reserve will now hold off on any tapering of its asset purchases, at least until November and perhaps even until its December meeting. COVID-19 remains a wild card, of course, but while it does, central bankers are less likely to start to withdraw stimulus. Let's look at what the equity market internals are telling us about likely future performance. This chart from JP Morgan Asset Management breaks down EPS growth in S&P 500 stocks into its constituent parts. Margin growth is shown in gray, revenue growth in green, changes in the number of shares outstanding are highlighted in blue, and total EPS growth is represented by the orange diamonds. What stands out immediately is that EPS growth in 2021 is at the highest level we have seen for 2 decades, and it comfortably eclipses the prior high point seen in 2010. What's more, as was the case in 2010, the growth in overall EPS is being boosted by rapidly increasing margins, growth which is outstripping the growth seen in revenues. Yes, S&P 500 companies are selling more, with revenues up by 15.4% on average up until the last week of August. However, the S&P members have been able to boost their margins by 49.7% in that period. That means that they're making more money out of existing sales and more money out of incremental sales growth as well. With margins and revenues both growing at a clip, it's not surprising that analyst earnings forecasts for the S&P 500 stocks continue to rise as well, as we can see in these charts, which again are drawn from research by JP Morgan Asset Management. Analysts' consensus earnings forecasts for 2021 are shown in light blue in the left-hand chart. And whilst the Q3 earnings season in the U.S. doesn't get going until mid-October, there is no obvious sign of pessimism in this. The right-hand chart here plots earnings growth among the S&P 500 stocks and compares that against the change in the S&P 500 up until the 26th of August, and against multiple growth in the index. That is, the multiple that investors are preferred to pay to own the index at a given rate of earnings per share. That multiple growth rate is falling and was down by 6.3% over the year to late August. What that means is that rather than equities becoming even dearer to own, they are in fact becoming better value, even as their share prices rise. If earnings can continue to grow at the same pace seen in the first 2 quarters of the year, then that multiple could continue to fall further. That is a big if, of course, because supply chain interruptions and labor shortages are pushing up prices, which in turn can eat into a business's margins. However, even if the 64.36% EPS growth seen over the year to date were to be trimmed slightly, that needn't signal panic situations, and one could argue that some kind of pullback would actually be healthy for the market. However, if the pace of earnings growth can continue, then blue chip stocks could actually be considered cheap in the run into the end of the year. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.